Good afternoon and welcome to today's webinar program titled The Impact of Current Economic Conditions on Insurance, an Overview for Regulators. This is a collaborative presentation of the Institute's Griffith Insurance Education Foundation, the Insurance Regulator Education Foundation, often referred to as IREF, and the Katie School of Insurance at Illinois State University. I'm Frank Tomasello, Executive Director of the Institute's Griffith Foundation, and your moderator for this session, which features the insights and the expertise of Dr. Michelle Lennar, Chief Economist and Data Scientist, Head of the Economics and Analytics Department at the III, and also adjunct faculty member with New York University's Economics Department. To learn more about Dr. Lennar's background and research interests, we invite you to visit Griffith Foundation's website at www.griffithfoundation.org and simply select the link to this program's registration page. There you will find his biographical information. Dr. Lennar, it is a pleasure to have you with us. We welcome you to our microphones.
It's my pleasure as well, Frank. How are you today?
I'm well, thank you, sir. In the hour ahead, I welcome your insights into current economic conditions and to look at their impact on insurance and, by extension, our audience of public policymakers. Before we begin, let me remind our attendees of just a few items. First, participants may ask questions, and they may do so by using the Q&A feature within this webinar interface. Questions will not be visible to other attendees. I will review all incoming questions and will pose questions as time permits during the final segment of our session, which will be about 15 minutes or so, the remaining 15 minutes of our hour together. Today's program is being recorded, and it will be available for on-demand playback in the days ahead. Folks interested in accessing that recording may visit the Griffith Foundation website, and we'd encourage you to share that information with your colleagues as well. In keeping with the respective missions of the Institute's Griffith Foundation, IREF, and the Katie School of Insurance, today's program is purely instructional in nature. It does not support a position on any issues. While today's discussion will focus on current economic conditions, please note that on April the 19th, we'll deliver a second session, and that will explore the economic outlook ahead and what it may mean for the insurance ecosystem. Dr. Lennar will join us again on the 19th for that program. You can find details and you can register for that session again at the Griffith Foundation website, www.griffithfoundation.org. With that, Michelle, we have lots of ground to cover. To kick things off, may we call upon you to share your view of the current economic landscape, I should say, and then we can delve perhaps a bit more deeply.
Absolutely, Frank. Thank you so much for this opportunity. It's always a great pleasure to speak to you and with your audience. Welcome to everyone out there listening to us today, and thank you for your time. Our goal today is to talk about the impact of current economic conditions on the insurance industry and the P&C industry, and really try to do so in the way that is relevant to regulators and to those of you in the audience who play related roles in the industry. Just a little bit of how we structured this presentation. I've structured this presentation. 3 sections. Economic landscape and outlook. We'll be focusing on the current landscape. Then translating the economics, the macro, the GDP, the CPI for our industry, for the P&C industry. And again, trying to look at issues that may address considerations that the audience is focusing on, is concerned about. And finally, key related, again, a bit deeper and deeper, key related public policy questions, and such as solvency and others that, of course, are central to the mission here of our audience. It is referred to as 3 sections, but don't be alarmed. This is about a 40-minute, 35 to 40-minute presentation, and then we'll be able to have questions there. So it is very much structured as an overview and so forth. And again, there will be a Q&A at the end, and look forward to answering any questions that you may have in this regard. And the presentation will be available online, as Frank has explained as well, if you want to go and get it. So let's dive into this. If there's one thing you remember after today's presentation, about this presentation, don't focus on the numbers or the specifics and the percentages. I mean, that's important, but really what I'm hoping to convey today is a structure, is a way of processing economic news, economic numbers, what you see when you turn the TV on, uh, and translating that for our industry. So how do we think about GDP or CPI, growth or inflation? And how do we translate that? How do we transition that from this conversation about economics, which is macro, which is about the country as a whole, the data as a whole, and so forth? How do we relate that, translate that for insurance, for P&C, and for specific lines? So first, I'm going to start again in this first section as to that overall conversation that you may hear again when you look at the press, when you look at news, when you hear about the Federal Reserve and so forth. The main anchors of the economic conversation are always about GDP growth and CPI inflation. Traditionally, economists refer to these as the two drivers. One can go to the upside. Too much growth will bring about, quote, quote, too much inflation, and not enough growth can actually lead prices to go down. Economists have all sorts of theories about what is the optimal relationship between growth and CPI, and that's where folks' perceptions may change. That's where you hear concepts such as, should we increase inflation? Should the American worker be punished? We've even heard some of that language. And really, at the end of the day, putting aside those words, what it means is that there are give and take. If we have more and more folks working, there's more and more demand, which is a very good thing. But then all things being equal with supply, the amount of good that we can purchase being the same, it pushes prices up. And even when it comes to inflation, there's different views there. We tend to be here in the United States in the system where the Federal Reserve, as a result of public policy consensus through the electoral process, through the government process, and so on, the mandates, is to really maintain an equilibrium between inflation and growth, and sometimes let go of some growth to ensure that price remains stable. In other countries, at different times in time, inflation hasn't been as much of an issue. And so we're not going to go too much into that right now, but I did want to say that that's kind of where the economics, the nuts and bolts of economics, as the lack of, as a consensus ends. Right? All economists agree about these basic rules. But then when we get to this issue of how much inflation versus how much growth and what's the give and take, that's when you have this conversation about different economists, different policymakers, and so forth debating. Right now, you're seeing that very much so with everything we're hearing about the Fed. That's what the Fed is focusing on, with how much inflation, how much growth, and so forth. So at this point, we're looking here at 2021 to 2025. The first row is GDP growth. That's growth, GDP, gross domestic product. And you can see that it was very high in 2021, and it's been coming down to just below 2%. What is a high? What is a low GDP? Again, it's different depending on the country, but in the United States, traditionally, we'd like to be between 2 and 3.5%. That 2% number is a very good number across the board. Like the Fed tends to keep CPI, inflation, below 2%. And then if you get above 2%, they're going to start increasing interest rates, and then growth should be a bit above that. You always want your growth to be a bit more than your inflation and so forth. So the view here is that after with the pandemic, a lot of supply and demand was out of sync, which meant that demand actually increased. We suddenly had to buy things for working from home. I'm at home here and working from home. So I had to buy a computer, I had to buy this backdrop and so forth, a better desk, lots of purchasing. Folks had more disposable income, pushed inflation up. So as a result of that, now inflation is going to come down, but it's depressed growth. And that's why we're expecting growth not to be as strong for a little bit. So again, here, you can see that I'm focusing on the big mechanism and the building blocks of this. And what is growth when it comes to those components of growth that are relevant to us in the insurance industry. And I'll dive into that. But what I'm going to do here is, if you're looking at this, so the GDP is an index of sort, and it looks at different components. So it's a CPI for inflation. And within this, we have these components. So and there are multiple tiers. So you can look at shelter, and next to shelter, there will be household goods. And within household goods, there can be something for shoes, something for apparel, etc. So think of it as a decreasing there. But these are areas, these are level one components of the GDP, products and so forth, that actually drive areas of the economy that are relevant to us. And what I'm going to do in the second section is I'm going to reorganize these into insurance lines. So if you're looking at housing starts, construction employment, retail trade, those are relevant to construction. That means that they're going to be relevant to homeowners. They're going to be relevant to commercial construction. And you can see here that US GDP as a whole has been slowing down. Now, P&C underlying growth, so this is this different basket. There's a GDP basket, everything in the economy, and then there's what's more relevant to insurance. We actually had a tough time in the industry in the last few years, but as we're emerging and returning to normal, because we had a much tougher time, there is hope, quote, that we'll be a bit better off for a while. Now, the message here is that we're coming out of an area where our growth has been a fraction when the overall GDP was growing at 6 and 7 and 8%, almost as high as that, we were almost negative in terms of our growth. So the fact that suddenly, and that had considerations, you cannot have insurance product that consistently grow smaller than the rest of the economy. So even though right now we're going to have maybe an advantage, maybe about the same, or just slightly less. So we're not going to be in the same quote, quote, dire place in terms of our growth versus the rest of the economy, insurance growth versus the rest of the economy. We still have this legacy there of 2 or 3 or 4 years of very low growth. And that's even more pronounced on the inflation side. Inflation, even more so than growth, is what is really impacting our industry right now. So this is an image that we put out. This is something we put out for consumers and so forth. So inflation into replacement costs and into the premium. So in the rate setting process, this is very important. And I'll give you some numbers as to the difference between overall CPI. At one point, overall CPI for the US reached about 8%. You may remember that was about 8 months ago before it started to go down. Replacement costs for those goods within the CPI that were most relevant to P&C lines was twice as much as 16%. So you're starting to see this picture here that the pandemic era was quite difficult for the insurance industry. Policyholder surplus remained strong and so forth, but the environment, the macro fundamentals were challenging. On the growth side, there was less growth, and on the inflation, there was twice as high inflation. So here's an example of that. You can see that in 2022, the CPI just started again to be above, and that's by the end of the year. Now, if I had shown you these numbers about 6 months ago, you would have seen that the replacement costs were around 16%, and the inflation overall was 8%. It's important to mention here that it just never happens this way. For inflation in a place like inflation historically in the US has been around 3%. Again, slightly above the Fed's target, sometimes a bit low, but 2 to 3%, you can say that. For inflation to reach 8%, in the speed that we did, unheard of in the United States. And for it to decrease from that 8% to that 6 and to that 5%, also so rapidly, incredible. And that the economy is resilient. It's not as regulated as other economies. There's no price controls and so forth on most goods in the United States. So that flexibility allowed the system to continue and so forth and to operate probably comparatively better than others in terms of adjustments. But again here, and this is the rate setting component, this is the overarching, yes, things are improving for the industry right now. We want that. This is good for the insured. This is good for a variety of reasons for us to continue with our mission to be there and repair and rebuild for folks. At the same time, we have 3 years of very difficult environment. We did some numbers recently, and the average increase in replacement costs over the last 3 years has gone up 40% for the insurance industry. 40%. So if you think that that's what we do, we repair and rebuild mostly, so in the P&C side, things side, liability and so forth, the cost basis has gone up by almost 50%. And in some lines, homeowners, it is 56%. Rate increases have not stayed at the same pace, and that's understandable. Always a conversation with regulators and so forth, and that. But it does mean that for the viability of the product, for the capacity, viability, economic terms, and so forth, it's these decreasing numbers are going to provide, in terms of replacement costs, are going to provide at a time there for, from an oversight perspective, from an industry perspective, really look at the difficult, challenging 3 years on an economically viable basis for the pricing mechanism of those lines, of those PNC lines. It's going to provide breathing room there to adjust, not that 40% overnight and so forth, but that 40% year in 1 year, but really taking advantage of the 1.7, for example, versus 2023 versus 5.6. If we didn't have that, it'd be very challenging for the industry. And that's something that the industry, regulators, legislators, and everyone, and insured should welcome. Again, it allows for this equilibrium to come back into place. Monetary policy. So the reason this is here is because the Fed, if you want to get a bit technical, there's a document from the Fed that actually will provide their longer view. And this document refers to the governor's, the Fed governor's own forecast, and they're very specific. And there's often a disconnect between kind of the more right now conversation that has a lot of this give and take between growth and inflation and employment and where they think things are going to go. And the concern there is that the Fed's governors do think that their own 2% target for inflation in the next few years long term is not realistic. And they're themselves saying 2.5, and then they're continuing to see growth below that number at 1.1. Now, this is real GDP growth. The real mean it's adjusted for inflation. So having inflation higher doesn't mean you're not growing at all. However, it's still concerning. In a good economy, you want your growth to be above your inflation. You want your real adjusted to still be above your inflation, and we're just not in that environment. So that's going to be challenging for the whole economy, and certainly for the insurance industry as well. Okay. So about a third here through my presentation, just to keep track for everyone. And now that I've painted, what did I just do? I kind of provided an overview of those two key components central to what economists look at: GDP, growth, CPI, inflation. And I've talked about it in general terms, and I started to talk a bit about it in terms of how it's relevant for the P&C, for the insurance industry. Now, what I want to be able to do here is to, instead of looking at it from the economist side, from the financial press side, to using an economic framework, I'm going to suggest a very different way of looking at it that starts with what we do in the insurance industry. So instead of talking about inflation, I'm going to focus on replacement costs. In terms of, instead of talking about construction prices, I'm going to talk about homeowners or commercial property replacement costs, et cetera, et cetera. So let's dive into that. But first, you can see here that our report card in the industry starts with our combined ratios. And we have a combined ratio model at III, which we do with our friends at Milliman. And you can see here the significant increases in the combined ratio from 2021 to 2022. And this is across all lines. Of course, much more important to look at individual lines. There's additional conversation. There's additional information available if you want to go to the III website or communicate with Griffith. We have more information here that is available for all of you if you want to. But you can see here that the net written premium have consistently increased, and that the occurred losses have also continued to increase. Our underwriting income, though, is recovering, but look at that there. I mean, it's been negative for many years, but -3 in the midst of the pandemic, but -51, these are billions, by the way, and then -29, -17, but at -51, that again goes to this lag effect. It was tough during the pandemic for everyone, and the insurance industry did not avoid that difficulty. And thankfully, we hope that the comparable improvement in underlying growth and the comparable improvement in replacement costs after these dire, very challenging years of 40% replacement cost increases and so forth will allow for a smoother transition to maintain policyholders, bring back combined ratio into a place where they're sustainable and so forth. And this is a consideration from a regulatory standpoint, where really that conversation about seeing how we can take the situation where we've been and where we want to go and have a smooth transition. And hopefully these numbers can be helpful in that regard. Now, I showed you this slide. I spoke to this slide earlier about underlying growth from a GDP standpoint. So let's look at the third row here, homeowners. I'm actually going to go back to it sometime. I don't do that during presentation, but let me just go back. So bear with me. So look at this, homeowners, personal auto, commercial property. I'm just going to go back to this one here. This is the same view, looking at it as an economist. Shelter, household, construction material, new and used vehicles. This is how you hear about it probably in the press, in economic reports, and so forth. But then if you're thinking of it as a regulator in insurance, if you're thinking of it as an underwriter, as someone involved in the rate setting process, this is what you're looking at. We've regrouped these components, these GDP components, into new baskets, and they are those baskets based on different lines. So for homeowners, I'm just going to use homeowners here. What does that mean in practice? Well, about 30% of the cost of repair and rebuild that P&C homeowner lines will do is about content. And about 60-70% is about the property, the structure, and so forth. So if we're looking at the homeowner's loss, that's based on some census data and so forth, and it changes over time. That's about where we are, 1/3, 2/3. The basket of goods, whether for growth, people buying more, or for consumption in terms of pricing, has to do with what's in the house, those goods, electronics, etc. The frame has to do mostly with lumber. So what are the prices of lumber? What's the growth of lumber? How much is lumber available? The economic drivers specifically for growth on homeowners would be housing starts. Now, those numbers there with homeowners are pretty well, like, they compare pretty well between what the industry needs to look at and what the GDP categories are when it comes to homeowners. It's not the same when it comes to auto, for example. The GDP numbers that the government reports, that the BLS, the Bureau of Labor Statistics, the BA, the Bureau of Economic Analysis, they don't report commercial vehicles and personal vehicles, personal auto. It's reported on the basis of the size of the car. There are more sales of light, medium, heavy trucks and cars and so forth. That's a challenge. One could think, well, the bigger the trucks, that's probably commercial. Yes, if a truck is really big, it's most likely commercial. It's not the same with small cars. Small cars used to say, oh, maybe probably individuals and so forth. Not anymore. A lot of the corporate fleets actually have compact cars, subcompact cars, and so forth. So when one is trying as an underwriter or as someone involved with the rate setting process or other related functions to look at growth, it's not just like housing starts. We don't have that. Just remember that. We don't have those indicators as relevant for cars. Sales, and so quite often what carriers will do is that they'll look at trends within their own portfolio, and that becomes even more specific. I had a conversation in the last few days with a member, and this is exactly what we zeroed in. When it came to homeowners, they have a good sense of economic trends. They could factor this into their underlying growth, which has a direct impact on net written premium growth. Great for homeowners, housing starts, housing completion, and so forth. When it came to auto, a bit more challenging. And then if you think of it, that some of these numbers, how they reported by government agencies, well, on the growth side, they're reported by state. Very positive. Carriers do think in terms of states and so forth. Obviously, the regulatory framework is at the state level and so forth. However, for inflation, where we're going to get it's by regions. There's 4 regions in the United States. North Dakota and Illinois are very different, just to use those 2 examples. They're both, however, in the same region when it comes to how inflation is reported. And I'll dig a bit into that. So the framework here, big picture, what to remember from this and all the kind of the more detailed stuff I'm going to is the folks involved with looking at growth, net written premium. In some cases, you can look at GDP and you have a direct line that's very clear, very helpful. In some cases, there needs to be a lot of other considerations taken into account. And by the way, you can see here that P&C underlying growth in 2023 significantly below US GDP growth. I think you can see my cursor, 0.4 versus 1.2. Level of confidence here with this 1.7 versus 4.5 is not as high as this. You know, economists right now, we all need a bunch of humility because we've never had these numbers. I put a presentation together, let's say it's 1.2. I lost sleep over the last few days about this 1.2. Traditionally, I could use the same number for a full quarter. Wouldn't change. If it changed, it would be 1.3. Not the end of the world. Still, want to be accurate, but not a different ball game. This number here was 5%, 6% as of Q4, Q3 of last year for 2022. It's changed this much. That means that when we went to the end of the year, we were talking all before the holidays. Last year, Thanksgiving, we thought the year was going to end around 6%, 5% GDP growth. By the time, there's all this talk about the recession and so forth, but still the numbers were holding. By the time we got the real numbers, and we just got the real numbers for 2024 a couple of weeks ago, we're at 2.1. That's a big difference. How do you plan on that basis? Not an easy task, and we normally don't have these issues. I can build a business plan around, or we can all do that around 1.2 versus 1.3. It's a real difference, but it's a different ballgame again if you have in 3 or 6 months an understanding of growth going from 2 to 6% or vice versa. So again here, remember that those numbers are changing right now, whether it's growth or inflation, at an incredible speed. So this may be our 4.5 and our 1.7 here. We need to have a view. We think it's going to improve. At the same time, we're not even sure about the end of this year. And again, humility on the part of economists, flexibility on the part of folks doing planning on the commercial side is really what we need right now. Lots of flexibility. Okay. I ran a few things with my colleagues about the relationships between basic macroeconomic indicators and some of the performance metrics we use. At the end of the day, we're looking at our growth, our replacement costs, and our performance. And as a regulated industry, we want to have a healthy profit, but also a reasonable profit. That's part of the framework. So what is the relationship? Statistically, is there a statistical relationship between GDP and combined ratio? Regretfully, there isn't. And this is an area, and I'll go into this a bit, where we're doing more and more research. Now, there should be a relationship between the performance of the economy and the performance of the industry. The fact that we can't capture it, and I'm going to get a bit technical, in what's called a linear, a basic regression, relationship between two factors, doesn't mean it's not there. It means that the statistics doesn't capture it. And that's probably the case here, because we know logically there has to be one. And it's not linear. It's most likely more complex. So we're doing a lot of work right now dealing with regression trees, machine learning analysis that look beyond linear, so indirect relationships and so forth. And we're starting to get significance there. And you can see here the correlation. You want to be close to 1 or to -1 here. And we're not even, we're at 0.3. And this is called a p-values, not to get technical. It's another verification of whether there's a mistake in that. So but in this case, again, you'd like that to be as close to 1 as possible. What we've seen, and this is something that from a regulatory and oversight standpoint and a solvency standpoint, one might think about, you don't want to have, where ought to be the logical correlation, relationship when it comes to combined ratios? Because we're looking at cars, and we're looking, let's say, at homeowners, the fundamentals of cars, of auto, of vehicles, commercial or not, as an insurance line, and of homeowners or commercial property, those fundamentals, they do relate to one another, but they are somewhat different, as we've seen, as we understand. Now, the correlation should be between the performance of the line and the fundamentals of the line. So it should be, let's call it silos. It should be silo driven. It could be vertical, integrated. What we're seeing right now is that there's much more correlation, significant, across those lines. Now, nothing that's bad. Nothing is bad or good, but it does raise concerns about is the way that the performance is driven, is the ecosystem in a way such that it reinforces certain trends, and that there's not enough of a difference between how the pricing is done in one line versus the other. Correlation, when you're looking at a basket of assets, is, and you think it's diversified, that can lead to issues, to concerns. It's kind of what happens with stock market corrections and so forth. So whenever there is a portfolio of assets or of products, you want the growth to be really about the fundamentals. And this is an area of investigation that we're working on behalf of the industry quite a lot. And we think there's an opportunity as part of this to actually even better price and to actually benefit ultimately not only to the carriers, but mostly to the insured. So much more to come in this area, but wanted to share a bit more technical conversation here than the rest I said, but I just wanted to put that out there. Inflation and replacement costs. Even more so than growth, inflation, replacement costs is what we've been most concerned in the industry. So again here, let's just do this little change in slide. This is the P&C professional view. The underwriter, the rate setting, the head of a P&C commercial lines or personal lines. This is the way one looks at the world, by lines. Now, these are the main lines we look at. Let's go back to those components. So inflation, key components, shelter, household, construction, vehicles, and so forth. So we reorganize these and we make them in the way that it fits. So this time I'm going to continue with homeowners as an example. So we've talked a bit about what drives homeowners, the categories of the GDP, housing starts, housing completion. Let's talk about pricing. So again, we have our 100% repairs and rebuild for a house, single family, standalone house. Let's make it as straightforward as possible for us. 30% of it is content. What's the pricing on that? Well, in content, you have furniture, you have apparel, you have shoes, depending on how it's categorized, it's within or it's not outside of apparel, electronics, TVs, computers, and so forth. Traditionally, all of that comparatively has increased below inflation price. The computer today, I always say, my mom sent me my documents a few months ago and she thought she was going to show how expensive that computer I got in high school was. And I knew it was expensive, first computer, around and so forth. Well, I adjusted that computer for inflation. It was $8,000 in today's money. I mean, I'm talking right now on a Mac. This Mac is $1,200 and it's way better of a Mac. So I went back to my mom and I said, Mom, she's in her 90s now. And I said, Mom, I'm an economist and I knew that it was expensive, but you really made your point there. It was about $2,000 for kind of the basics. Well, anyhow, so comparatively, now we have three computers or two computers on one computer. Comparatively, the price is less. Furniture, comparatively, and so forth, etc. So over time, people have put less and less stuff in their homes. Curtains, not as much curtains, that could be expensive and so forth. So there's an understanding there of those components, what drives the pricing. But when it comes to a house, we look at the replacement costs have been almost, mostly driven by the availability of lumber, the price of lumber, and so forth. Again, here it matches well. The categories are pretty much, here's the basket for the CPI, inflation, here's the basket that we want for, for our homeowners line. With auto, we have this problem here. With auto, it doesn't work as well because it's not structured as personal and commercial. Auto is structured by side. So what we have found at the macro level, I can just give you a little bit of the thinking here. And if you want to follow up with Frank and with the foundation and the institute, please do so, and we'll be glad to answer. But what we've done is that we identify patterns as to how differences in prices between commercial fleet for vehicles and personal autos. In general, the bottom line is that the commercial side of it is less volatile. And that makes sense. Large fleet, negotiate over time and so forth, year to year, et cetera, a little more there of stability. The challenge we have, and I'm going to move on to the next slide, but the challenge with inflation is the data is reported. Another challenge is that the data is reported not at the state level, which is a workable unit, relevant certainly to us in the industry, but at the regional level. And what we've seen is that up to about 10 years ago, we, following these economists, not only in insurance, but also elsewhere, we would think, how do we bring this back to a state? So we have the Midwest. How do we take the numbers for the Midwest and make them about Ohio, for example? So there would be a lot of work done in terms of trying to regress. So there would be, you find an anchor, the price of, let's say, the price of a house, and then you move the whole average for the Midwest to Ohio. Then let's say you bring, the Ohio as a whole and so forth. What's increasingly apparent now is that shifting from the region to the state, when it comes to pricing for replacement costs and other categories, isn't really as useful as it used to be. What we're seeing now is that the real unit is downtown areas, urban downtown, suburbs, exurbs, and rural. It's not even urban and rural. It's really about these three areas. And if you speak with some of your colleagues on the industry side, some of those that you're overseeing and so forth, the oversight process, you're going to find that we in the industry also now think in terms of expansion. Do we want to go urban? Do we want to go suburban, exurbs? And by the way, exurbs is really the place where things have changed greatly as a result of that. And then you overlay with some of these considerations, pricing, so you can overlay, you suddenly have a framework where you can overlay extreme weather event, where you can overlay movements in pricing and so forth. So again, just sharing this with you here, that the way we try to take this, the available data and translate it and take it from the regional, national to the regional to the state, that works for GDP, for growth. It works less for pricing. For pricing, you really want to think in this regard, and zip codes as well as census can be very useful for that. And then you don't want to go too local, et cetera, but we're finding that that's an interesting component there. Just checking in on the time here, great. Again here, just wanted to show that very surprisingly, very little to no correlation between CPI and combined ratio, inflation, replacement cost, and combined ratio. Doesn't mean there isn't. There has to be one. There clearly is one, but there are a lot of other factors, intervening factors, and it's not captured by linear analysis, linear statistics. Moving beyond linear analysis will most likely allow us to identify some of those relationships. And again, this is an area where greater understanding will really enable to have a more data-driven understanding of economic viability, rate setting, and so forth. Now, I want to point out, kind of before I get into the final section, the industry, reasonable profit but minimal profit when it comes to the underwriting function, as we saw earlier in terms of underwriting profit. Certainly, a large source of the industry's income is return on investments, whether it's income from fixed income type instruments, from bonds and so forth, or is capital gains from equity and other sorts of capital gain driven property and so forth. It is important to, and as you all know, because of what you do in your function, in your oversight function, the industry is mostly about fixed income, and the industry is very prudent about its risk management. But the question, of course, from a regulatory standpoint, always on our mind on both sides of this, it has to do with solvency. Challenging environment from an underlying growth and an inflation perspective. Throughout the last 4 years, I mentioned 40% increase on cumulative increase in replacement costs, but we've seen that there was a steady increase in losses, and there was a steady decrease in investment income. However, the combined ratios did suffer in some cases, but certainly the solvency, the economic viability of the industry remains very strong. And one component of that is prudent asset risk management and asset allocation. So let's just, the numbers, this is from NAIC, and it's up to 2021. You can see here that the assets under management in billion have continued to increase. We're about That's 2 trillion, by the way, and it's about half of what the entire industry, if you move beyond P&C, but your life and other categories, it's about 4 to 5 trillion. It's one of the most important source of group of capital, by the way, in the economy, and a lot of it can be applied in effective ways. But see here how the exposure to equity can change from 21% to 26%. We're much more prudent than other countries. In some countries, I have seen exposure to equity as high as 40, as 50, and 60%. That means there's a great deal of vulnerability. But not only are we always prudent with equity and other classes, we also tend to, as an industry, on the asset allocation standpoint, anticipate much ahead corrections. So as soon as there was volatility expected in the market, we really reduced some of those equity exposure. And then the capital gain, you can see like these numbers continue to increase, but look at this 53 number here, decreasing from 55, but our capital gain was able to make up for it. So again, the asset management within the context of very precise flexibility rules and so forth allows really to move across. But again, I want to just look here. I'm sorry it's a bit blurry, so sorry about that. I'll fix that in the final one. You can see here that it's 48-50% in government bonds, public equity, very little in private equity, very little to none in hedge funds. And so in the others, by the way, it's a lot of cash, it's a lot of owning in subs and so forth. So very conservative, but regardless, over the years, over the decades, the industry has shown its prudent risk management in this area and acting as a custodian. Okay, about 5 minutes left before the Q&A. So, and we're right on time here. So I'd like to kind of look at this from public policy considerations. Now, throughout this presentation, I have tried as much as possible, and I hope I've been a bit successful at it, to look at starting with the economics, translating it for the P&C industry. But as we do this, to really bring at every point, this is the way someone in the industry, as a head of a P&C line, looks at it. This is the way a regulator might want to consider. This is where the areas of interest may be. This is how you may decipher this GDP number. What does it mean for me when I speak with a carrier and so forth? So just zeroing in here more and more onto that. And a couple of weeks ago, as we were putting this together, I said, Frank, we really want to talk about here the banking crisis, because it has moved the markets. Now, I even saw something yesterday from a very well-respected industry watcher looking at and raising some concerns about contagion from the banking side to the insurance industry. So I've always wanted to look at the numbers. My understanding, having looked at this for a few decades, more than I want to admit, is that there hasn't been a relationship, a correlation or anything. Banking liquidity and carrier solvency do not overlap. 2007 had areas of this with AIG, but it was different parts of AIG, and it's a different consideration. So I said, let's go back and look at the number of carrier solvency considerations. So carrier failures, defunct and not acquired. We went to S&P, and we also, and S&P in this regard, looked at 50, each regulator's sites. You all have your website and so we can go to. So we actually went through and we said, okay, this is now, this is not a 30, 40, 100-page analysis. I just want to caveat this, but I just wanted to be able to say, let's look at aggregation from a respectable source, S&P, using data from state regulators, and let's plot this number, which, by the way, is fairly stable. If you look at it, it's in blue. That does show the level of regulation and custodian thing. And let's look at it against the banks. Well, we've seen a lot of bank failures and graphs, but I had never seen one nationwide for our industry. And don't need to run a regression if you're familiar with it to look at these two lines and say there's really no significant relationship. But we still ran it, and we still got no significant relationship. Now, that doesn't mean that we don't want to be prudent. That doesn't mean that insurance and banking are the two pillars of the finance industry and so forth. but it does show that the, the immediate reaction to say, oh, there's an issue in banking, there must be one in insurance when it comes to solvency, that's not a thinking that we want to follow. And specifically in this case, if we talk a bit about the banking situation, I'm hesitant to call it a crisis. I think we're now, the consensus from the Fed and other regulators is that existing rules within the banking, the Basel framework, Basel 2, 3, and 3.5, and so forth, existing rules are adequate to address that, and it's kind of shifted a bit. But what we're seeing here is that we also, through solvency and the solvency framework, have very strong. But I thought it was important to just put this out there, and not as a, oh, everything's right. We're never in that. We always want to be prudent and so forth. Not at all hear what I'm saying, but just wanted to say that we need to be aware of the stats and historically what's happened and so forth. Okay. I also wanted to have a sense of the policyholder surplus and regressing it with other factors, with GDP, with inflation. Now, policyholder surplus, as we saw earlier, and in one of the slides, is impacted by overall economic conditions, but it is not really about economic cycles. When we're thinking solvency, capital adequacy, and so forth, and we're looking at the policyholder surplus, the main relationship is not with the economic fundamental that drive the business, but it is with extreme weather events in the P&C sector. And I think I'm not saying anything new here, but again, it's always important, and this is a great way to use economists and statisticians and data scientists. It's always important to say, we have an assumption, let's go back and revisit it. What are the numbers telling us? 90% of the time, the numbers will confirm, but once in a while, they tell us something different. And that's when it becomes even more interesting. But what we're seeing here is that indeed it's confirming, because of what's happening again in banking, because of the dislocation in supply and demand that impacted P&C performance metrics significantly during and now in the aftermath of the pandemic economy. It is important to revisit these these assumptions, and make sure that they still hold. And thankfully they do, but it's always important to get back to the data. I'm a data scientist, so you would expect me to say that probably. I'm going to wrap up here before we open for Q&A. Regulatory issues outlook. So again, we tried here to, what did I try to do? I tried to provide kind of a framework to think about this. I like to say, if you forget 95%, 99% of what I said, what's the one thing that I think would be worth for you all to remember, that I would really like you to remember? You have baskets of goods and growth, CPI and prices. That's all great. But we need to translate that. And you translate that on the basis of a line. Homeowners, what does that mean for homeowners? And so the growth, the pricing. And then how does that impact, in turn, part of the revenue stream, the underlying economics of the products? How does that compare to extreme weather events and other considerations, and so forth? So hopefully, that gives you a bit of that. And now in the next part of this presentation, which Frank referred to, we're going to be looking forward. Where is the economy going? Where are these lines? Some of the table that I use already has some of those forecasts. And the next time around, we're going to be focusing much more, where are we going to be at the end of the year? Where are we going to be next year and the year after, and so forth? But some of the specific issues here, cyber risk, pandemic, equity, generational change, looking at them from an economic, from an industry standpoint, and so forth, as drivers of concerns, opportunities, etc. So Frank, I'm going to go back to you here for our Q&A, but this was the bulk of the presentation for today. So I hope this addresses some of our friends in the audience, their questions and so forth.
Indeed. Thank you, Michel. And a quick reminder, you referenced the forward-looking presentation. And as I noted, I think at our opening, April the 19th is the date of that presentation. You can find information on the Griffith website about that. So we invite folks to again, join us for that forward-looking piece. In the time that remains, please, you may submit questions using the Q&A feature. I'll have a look at those and we'll pose questions as time permits. To get the ball rolling, one of our attendees asks, Michel, with increased public awareness of inflation and higher prices, Are we seeing in any way a situation where companies perhaps may take advantage of inflation being in the headlines as a way to sort of push price increases up a bit more than necessary? And I think in many respects, you spoke to challenges over the past 3 years, the impact on insurers. So we have a fair, I think, a fair flavor for the challenges before all, including insurers. So in many respects, you may have sort of spoken to or answered that question, but do you care to share any added color in response to that?
I said something about these are the basic relationship from an economic standpoint, and growth on one side and pricing on the other side. And I said, this is where the economic, the data, the nuts and bolts, the framework ends and where public policy starts. And where and it's the same thing, fairness. Can speak to different individual. We have a sense of what fairness ought to be, what it is, but the specifics of it may differ. So where do we look for metrics that are in that realm of objectivity? And I think in our case, we look at those performance metrics. I mean, the combined ratios have deteriorated. They have deteriorated significantly. And that's right away at the end of the day, the combined ratio went down, which means that regardless of it worsened, which means that whatever is happening, it's been negative for the industry. And so first thing, second element, that's kind of the ultimate, check. The industry is not making significant, much more than usual profits. It's not the contrary. The second one is to look at the rate of increase in rates, in premiums, and the rate of increase in replacement costs. Now, replacement costs aren't 100% of repair and rebuild. There's other costs in there. But on average, in the last 4 years, during the pandemic economy, replacement costs have gone up twice as fast as premium for those individual lines. So again, this is a fairly powerful, I think, metric in terms of that relationship. Now, again, is this sustainable? Again, there's fairness and so forth, but the answer, I think, is not with questions about gouging, about over profiting. The answer probably points to how do we maintain the economic viability of these products, of these public goods in a way. How do we maintain that so that they're there when needed, regardless of these significant historical changes in the economic fundamentals behind them. So that is the way I would look at it. But those two specific relationships there, I think, are quite objective in that regard.
Thank you, Michel. Want to shift gears a bit. We have a participant who asks if there are any changes or plans to make changes to the way that auto growth and pricing numbers are reported to perhaps help industry with projections. And one would imagine that would also be helpful for those concerned with oversight from a regulatory perspective. So interested in your thoughts there, if you would, please.
Oh, I thank you for that. And if you are visiting the BLS or the BA, please convey our needs for that. No, I haven't heard of any specific. And there's, it makes a lot of sense for the auto industry. How do they plan it? Size of cars, and et cetera, et cetera. So I think for the time being, I have not heard of any. I'd welcome that. There is information when you go into the sales and you go very deep. Our friends at the auto vehicle related trade associations do fantastic work in this area. I'm sure that in my conversation, I have had pleasure and the opportunity to speak to some of them. They have a slight more advanced understanding there, but the fundamental issues remain. And also, from my perspective, as an economist, a data scientist, I like to use public data, and it's because there's a legitimacy to it. There's an objectivity. We know where it comes from. It's public. It's very important to have transparency in the public conversation around these issues. And I was discussing this with my students. And I say, there's kind of a give and take between specificity and transparency when you come to modeling or to using data. I would prefer sometimes to let go of the specificity so that there's greater transparency. I would prefer the models, for example, to be more basic, accurate, but more basic, having 2 or 3 variables for homeowners, for example, when it comes to price and so forth, than having 20. You can build it with 20, probably would be a bit more accurate in terms of 5.6 versus 5.7. But for the purpose that we're having here, which is different when we come to someone, a carrier specific rates, the level of specificity, that 5.1 versus 5.2 is different for them. And we try to work with them to help them have this information as with regulators. But the transparency, the ability to understand it, the fact that the data is public, Keynes, the economist from, I hate quoting people, but this one is one that I like, and Frank, I think you've heard it. I'd rather be, I think sometimes it's better to be generally correct than precisely wrong. And I'd say it's better to be transparently correct because we can have a conversation. And it's a bit, Frank, the question I was just asked previously about, are the profits excessive? What's the meaning of excessive? Okay, but there are some data that we understand. We see how it comes from. People understand. We're all speaking the same language. Sometimes a lot of folks in different professions like to speak their own technical language, and that makes sense. But again, in the context of this here, so that would be my answer to that. There's a lot of additional information, but it really becomes proprietary. It becomes car company specific, et cetera, et cetera.
Thank you. I want to ask you a compound question now because we have limited time here. Given the rising claims costs that you talked about earlier in the presentation, do you foresee, Michelle, claims automation, perhaps through parametric insurance, as a potential tool to help reduce costs in any way?
I'm going to give you yes and no answers since you said you have a few. No, we haven't found, and that's not my view. I'm a big fan of parametric. Part of the insurance that I was involved most hands-on with was parametric in nature. Credit insurance, for example, but or political risk. But we're not finding that that's helping those considerations. So far, in the way it's done right now, it's not a solution. It's a solution for many other issues, speed and so forth, but it doesn't specifically address those considerations you mentioned.
Thank you, Michelle. And then sort of a quick follow-up. We have a participant who asks, given the current rate of inflation, perhaps is there a particular level of price increase that's needed in light of the what we see in terms of current inflation rate? And my sense is there is probably no magic component there to be introduced, but we do appreciate your thoughts on that, Michelle. Yeah, it's a good question.
I will never comment on what is appropriate or not in that perspective, not just because it's really because of the specifics of each underwriting of each portfolio, diversification by state, exposure to extreme weather events, and so forth. That said, I think if I'm looking at replacement, common sense, if I'm looking at replacement costs going up twice as high, we have a sense of what replacement costs are in terms of the overall cost of repairs and rebuild and losses. And on average, the 80% before fees and admin and so forth. So, if the underlying fundamentals have increased, let's say by 35% after that, you have a 5% increase, probably all things being equal, not going to work in terms of long term. But that could be solutions dealing with a different cost of capital and so forth. There's a lot of different ways to do that, but a priori, probably challenging. And then there's the issue of you still want to be able to sell the product. Okay, there's a 35%, but if you increase 40% and 50%, well, that could be dislocating to not only, it could solve the issue of profitability, quote, quote, but it could also dislocate the ability of folks to purchase the product. So suddenly you have a product that's theoretically profitable, but no one can afford it. That's not good for anyone either. So, common sense and so forth. But from my perspective, given my role as an economist, I really look at this issue of cost of capital, availability of capital, and kind of this ratio of replacement costs as they're relevant to overall losses and costs and so forth. And those vary greatly from one. And that's where the economist, like me in this case, and the data scientist, passes it along to the actuary. And then the actuary is able to work this within this in conversation with regulators and so forth.
Thank you very much. We are nearly out of time, so I will pose a final question and ask for, if you would, sir, just a very brief, perhaps a 30-second response. We want to be respectful of the time of our attendees, but for those financial regulators and public policymakers who are interested in delving more deeply into the impact of the current economic landscape on insurance and the resulting questions before them, Can you suggest some additional resources for those who may want to become better acquainted?
Pick up the phone and call us. And I'm not dodging the question. Everything, it's all very specific to the state. It's different from one state to the other, from one line to the other. Don't hesitate. We're here for that. That's our mission at the III, and that's obviously a mission we share with you at Griffith. So do not hesitate. Reach out to Frank, reach out to us, and we will try to answer that as specifically as possible. There's much more available.
Understood. I thank you. It has been a fascinating conversation. We are out of time for today. It's the top of the hour. On behalf of our good friends at IRF, the Insurance Regulator Education Foundation, and the folks at the Katie School of Insurance at Illinois State University with whom we collaborate, I take a moment to offer my thanks to you, Dr. Michelle Lennar, Chief Economist, Data Scientist, the head of the Economics and Analytics Department at the III, and also adjunct faculty member at NYU's Economics Department. Thank you for being with us. Really appreciate the conversation and the insight that you shared, Michelle.
My pleasure.
Quick note, as mentioned at the beginning of the program, Dr. Lennar has kindly agreed to join us again, April the 19th from 1 to 2 p.m. Eastern for a forward-looking session on the economic outlook ahead, what it may mean for the insurance ecosystem and by extension for you all as public policymakers. So I invite you to join us for that. My friend and colleague, Jim Jones, the Executive Director of the Katie School of Insurance at Illinois State, will moderate that conversation. Again, a collaborative program. You can learn more at our website, and you can register for that complimentary webinar at griffithfoundation.org. A special thanks to Michelle Telford of the Institutes for her production assistance. And last, but certainly not least, a heartfelt thanks to all of you who attended today's webinar. In the days ahead, a link enabling on-demand access to the program will be available and posted to our website. We invite you to please feel free to share that with colleagues. With that, until next time, I'm Frank Tomasello of the Institute's Griffith Foundation. I bid you a pleasant good afternoon.